For quite a few months now, the stock market has started looking really overpriced. I've been seeing all kinds of articles indicating exuberance in the markets and quite a few comparisons to the dot-com bubble. It certainly feels like we're reaching some kind of tipping point. However, I want to keep this video fairly neutral as I don't have a crystal ball and I don't want to go scaremongering everyone into selling up the whole portfolio. And the stock market could keep going on up for a long time yet before we see a crash. I do think it is really important though for normal people like you and I to understand when the market looks overpriced and to understand the signs of that. Many investors today just haven't been around long enough to experience a crash and literally think the stock market is just a money printing machine. So in this video I'm going to talk about some of the signs that we might be in a stock market bubble. Now I said this in my last video on Tesla, but right now it just seems like there's so much exuberance in the markets. So many people are investing on trading apps like Robinhood and putting money into companies without even looking at the fundamentals, without looking at the financial health of the company, which seems pretty crazy. This is the ludicrous index showing the number of companies that more than doubled in price in the last few months, and we are now approaching dot-com levels. This is the Goldman Sachs non-profitability tech index showing a surge in price of loss-making companies. And this is the Schiller PE showing the relative priciness of the market over time. We are now at the highest levels ever, excluding the dot-com bubble, and we are fast approaching these levels. I don't think that fundamentals are everything though. You could have invested in companies like Amazon when they were loss-making and made an absolute fortune. The market moves in cycles. We have recessions on average every 7 years, and apart from that blip last March, we haven't had a crash since 2007. Now I don't think it's a good indication on its own to look back at history and say it's happened this frequently, so it's going to happen again. But it's really good to be aware of this. So we're going to come back to the Schiller PE in a second. I think it's really important to look at the price to earnings ratio of the market as a whole and understand whether it looks expensive. Essentially what this tells us is how much earnings is the market producing compared to how much you pay for it. So a really good way to think about this is to compare with real estate. Say you were buying a house for the rental income and you bought it for $100,000 and its rental income was $10,000 per year. The time it would take you to get your money back would be 10 years. Now say in a really inflated market, that house cost you $300,000. For the same rental income, that would take you 30 years to get your money back. Now I think I'd prefer to buy the house at $100,000 and have my money back in 10 years than 30 years. It seems like that's a much better deal. Essentially, and in a really simplified way, this is what the Schiller PE is showing for the market as a whole. So it shows the S&P 500 market cap divided by the earnings. So if you bought the index in 2009, it would take you roughly 13 years to get your money back in earnings. Whereas right now we're looking at a Schiller PE of around 35, which seems pretty high, especially if you were to then compare it to the 120-year average of around 15. Now I don't think you should look at this in isolation and say, okay, we're above average, so we shouldn't invest, because had you done that 5 years ago and bought in when the Schiller PE was 25, you would have missed out on some serious gains. You might also look at the last 20 years and say the average is much higher. And this makes sense because there's more investing going on. The democratization of investing has meant that there's just more money in the market. So I would kind of expect this higher level. But even at this higher average of 25, we're still looking at an overpriced market. Another indicator of a potential market downturn is a really hot IPO market with super high valuations. Now I do think that Airbnb is a really great company with some serious long-term potential, but when it went public last year, it left the CEO literally speechless at the price.
When we, in April, we raised money, and it was a debt financing, that price would have priced us around $30. So I don't know what else to say. I'm very humbled by it.
Now I think this kind of tells you something. When the number one person that knows the company best in the world doesn't know what to say about the valuation, it's almost as if he's saying that's just too much. Lastly, many investors, and one of the greatest investors of all time, is sitting in cash right now. Warren Buffett controls around $250 billion and has about $140 billion in cash right now, meaning he hasn't found anything that he thinks is worth investing in at that price. And remember, this guy knows the markets and he's in it for the long term. If you'd invested £1,000 with him in 1965, that would be worth over 25 million today. Had you done the same in the stock market, you would have earned only a couple $100,000. Now I really don't know what's going to happen, but there are definite signals that we're in bubble territory. It's really important though to look at the other side and see that the markets could keep going up, as the central banks could keep printing money, as interest rates could remain low for years, meaning that companies are earning more money on money that they borrow, and meaning that investors are investing in stocks rather than bonds, which are earning low rates, And lastly, we're in modern day. Maybe we are going to avoid crashes from now on. Who knows? However, I'm not your financial advisor, so look into it yourself and be aware that there are some signs that we're getting into some seriously bubbly territory and we could see a market crash in the next few years.